My name is William Meadon. I've been a fund manager for over 35 years, the last 27 of which have been at JPMorgan Asset Management. And for all that period, I've been a specialist in UK equities. I was appointed to run JPMorgan Claverhouse Investment Trust in March 2012. And I was joined by my current co-manager, Callum Abbott, in 2018. Claverhouse aims to provide a combination of both capital and income growth by investing in a portfolio of some 60 to 80 UK stocks, the vast majority of which are quoted on the London Stock Exchange. Generating income is very important for Claverhouse. We have just announced our 51st consecutive dividend increase, and that is the longest consecutive run of dividend increases of any investment trust on the London Stock Exchange invested solely in UK equities. We have achieved that by investing in a combination of both value and growth stocks. We see merit in both value investing and growth investing. So this is a pretty balanced fund. It isn't a style fund and it isn't a style timing fund. And the most important criteria is that stocks, before they get in the portfolio, meet very high standards of quality in terms of cash generation, dividend cover, quality of management, strength of balance sheet. There's a number of factors that come together which have to be met before a portfolio consideration is given to them. And that approach has enabled us over the years to produce that enviable dividend record. When dividend growth is plentiful in the market, the Claverhouse board tucks some money away into reserves, given that stock markets are cyclical and you can go through times when dividend growth is not plentiful. At times like that, we, the board, draw on those reserves, and that approach has enabled us to produce that dividend record of 51 annual dividend increases. The investment process of Claverhouse is one that is looking for the very best value stocks, the very best growth stocks, and knitting them together in a portfolio which will give a consistency of returns for shareholders, both in terms of capital growth and income growth. The most important criteria is that stocks meet a fairly high bar that we set in terms of quality, in terms of cash flow, quality of management, and so forth. And then when all those come together, the stock will be considered for investment in the portfolio. So one such idea is 3i, which is a company which invests in a basket, actually predominantly unquoted stocks, which normally we couldn't get access to. But the management of 3i have got an excellent record in delivering growth from those portfolio of stocks. Their biggest holding is something called Action Group, which is a discount retailer in Europe, which has the most phenomenal growth as customers in Europe trade down through the cost of living crisis to more discounted products. And Action has tapped into that very successfully. That is more than 50% of the 3i portfolio. And we think the opportunities for further growth there as it expands across Europe are considerable. Claverhouse currently trades at a small discount to NAV, some 4.5–5%. And that varies over time. Some 18 months ago, we were trading at a premium where we're able, and we did, issue new stock. But currently, discounts have gone out generally in investment trusts. We've been no exception to that. But our discount of 4.5–5% compares favorably with many of our competitors. I think the current discount on the average investment trust is some 15 or 16%. So we traded a small discount, but it's pretty good compared to most of our competitors. Claverhouse does have a discount control policy, which I think is reassuring for shareholders because the company has the ability, and indeed until recently was issuing shares at NAV or a premium. And I think it should be a comfort to shareholders that when the shares slip to a discount, as they are at the moment, they are underpinned in that the board can go in and buy back at 5% discount, which is what they've been doing this year. Those shares, when they are bought back, are held in something called treasury, in that the company holds them in a sort of pending account. Those shares aren't eligible for dividend. And then, cyclical business that we're in, when the shares start to trade at NAV or a premium, those shares are then issued back out to shareholders and, of course, are then eligible for the dividend payments. Claverhouse is a December year end, so a calendar year, and during the course of that year, Claverhouse pays 4 dividends, 3 interim dividends, which tend to be of the same amount, and then 1 final dividend, which makes up the total for the annual. So last year, so December 2023, Claverhouse paid 3 interim dividends of 8p each, and then the final dividend, which has just been announced for December 2023, was 10.5p. So that makes a total of 34.5p for the year, which was a 4.5% increase on the 33p that was paid for 2022, and it was the 51st consecutive dividend increase. At the current share price of some £6.54, that 34.5p therefore provides a dividend of some 5.2%. So the shares currently are yielding 5.2%, sitting on a discount of 5%, and have increased their dividend every year for 51 years. And because of those substantial reserves that the company has, which enables that smoothing of dividend, that gives us and the board a high degree of confidence that we can keep that excellent dividend record going.